Hello, everybody out there. Super excited. You got one of them topics, taxes, that people oftentimes don't like to talk about. I love it. And what I kind of tell people is that like taxes are typically going to be one of the largest expenses you have in your life. A lot of times people don't realize it, but again, one of the highest expenses that you can have. So we're super fortunate to have Josh Irvine here. He's a master of all different types of things, and he's kind of going to be walking us through different strategies that we can kind of look at to employ to be able to try and keep back some of that money that you would typically have to um, spend on your taxes. Again, I mean, depending on where you're at in your investment journey and the amount of capital that you're making, 30, 40, 50% of your total earnings go to pay taxes. So how can we some tips and tricks on how we can mitigate that, be able to keep more money in our pocket? The more money we have in our pocket, obviously we're active investors out there, the more money we have to invest, and then the compounding effect is just that much more. So we do have some technical difficulties. You guys can only see me, but Josh is here. So Josh, maybe go ahead and introduce yourself.
Sure. And I will play with some of these slides. You make sure that people are seeing these slides. I don't know. So this should, I don't know. Can you see this new slide that I put up? I'm looking at
And
your
no,
screen.
give me one quick second and I'll get it up.
Okay. Just making sure. I just
There
don't
we
know.
go.
Okay,
Now
cool.
we can see it.
All right. So, yes, I am an attorney. I have my own law firm. I have a couple other ventures. I deal with a lot of construction and real estate developers, investors. So I deal with a lot of lien issues, um, and I serve in court in various small claims courts as a judge. And so sometimes the things I talk about are things I've seen on the contract side as well. I am licensed with the IRS. I'm also licensed with the U.S. Tax Court, and so sometimes my clients need to deal with issues that are audits, deal with appeals, after the fact. And so, actually, that's kind of the background from why I started getting into taxes. Not only am I nerdy, but it was just kind of a venture to better serve my clients. They were just kind of walking around and they'd go from one professional to another professional, and they felt like they just weren't getting a lot of coordination between all the different strategies. And so that's been kind of my approach. For those that don't know me that well, I'll also kind of give you some personal stuff. I love hiking mountains, and I also teach in the business school at Weber State, and love doing stuff with my boys. And these are some of those pictures. And so, not that that probably changes the tax stuff we're going to talk about, but it's nice to know we're all real people here. And I will also give you guys some opportunities and some ways to reach out and get a hold of me if that's something that's helpful. I'm going to give you some of those just as a thank you for coming and spending some time with us on an evening when you could have probably been doing a ton of other stuff. And so, I mean, here's the bottom line, and Chris has already kind of queued it up. Uh, when we talk about taxes, sometimes it's daunting. Sometimes it just feels like this big mountain that we just got to deal with, and we might not really know how to do it. And um, I guess the one disclaimer is that there's no such thing as a one size fits all. Like, a lot of the things I'm going to talk about, that it might apply to you in your situation. It might be something you've heard before. It might be something completely new to you. Um, and that's why I offer, kind of some follow-up calls if those are helpful, because you got to ultimately decide as the owner, as the investor, as the business, which of these strategies you take, which you adopt, which ones you leave. Um, that's just the reality. And so this is hopefully educational, but also tries to break it down into bite-sized pieces. My goal is that there will be something for everybody tonight. But I'm not ignorant enough to think that everything we talk about is going to apply to everybody's situation. So just know that from the beginning.
I want to just jump in real quick. If you guys, everybody out there on, you guys are all watching through YouTube. You guys can. There's a live chat in there. You guys can put your guys' comments in there. I'll interrupt and I'll ask my own questions. But if you guys have like specific questions, go ahead and ask it. We want this to be as interactive as possible as well. And again, tap into Josh's like us ultimately it's a phenomenal wealth of knowledge, and tap into it. If you guys have any questions that you guys have seen, again, specific to taxes or maybe risk and liability, he can help answer it in today's webinar.
Yeah. And just kind of preview, these are kind of some of the areas that I'm going to try to hit tonight. We're going to talk a little bit about the tax man. We're going to talk about taxes and how they just generically work. We're going to talk about asset protection, pros and cons, different strategies that can utilize for you. We're going to talk about the inevitable thing that comes to all of us, death. We're going to talk about how taxes impact us there, how we can plan for some of those things. We're also going to talk about how to grow our business within the constraints of those first three items. The reality is we're all dealing with taxes, we're dealing with liabilities, we're dealing with the eventual end of it all. And how do we structure our business the right way today so that we can grow over the next number of years and decades in a way that makes sense for us. And then there's going to be kind of like a wild card grab bag at the end. So if for some reason we're not hitting everything, make sure you ask your off the wall questions. If at no other time, make sure you ask them at the end so we can get as much as possible to you. So Taxman, this is a fun little history thing. I don't know if anybody knew this, but Taxman was a song that was written by the Beatles. And it was because their accountants gave them some good news, quote unquote. And we've all heard this before, but their accountants advised them that despite the fact that they had millions and millions of dollars or pounds at the time of success, two of them were close to being bankrupt and the other two were almost being bankrupt. And it was because at that time there was a special premium tax on all of their income. I think it was like 90 or 95% of their revenue was going to go towards taxes at the time. And so if you ever feel discouraged about taxes, just, I guess, look up this Beatles song called The Tax Man, because they felt the same way. The reality is, when we talk about taxes, the most frustrating part that I've seen, that I hear all the time, is that a lot of the people that do our taxes and that have done them for years are much more of a reporting function, meaning they put in the accounts, they put in the data, they file the reports, they file the returns, and then they just say, good job, you've had a successful year, good job, you sold your properties for a profit. Oh, P.S., here's how much tax you owe. And I'm not saying that that's not an important function, but that's only half. If you don't have a planning part, then that part, the reporting part, it could be done by a lot of people. And frankly, I mean, I can't say for everybody, but 99% of the time, if all you have is someone who files taxes, but you don't do any kind of planning along the way, you're leaving money on the table. Now, I know some people would rather pay a little bit more in taxes than risk an audit or those kinds of issues, and they don't want to break the law. And I'm not saying you should break the law, and I'm not saying that anybody wants an audit, but there needs to be at least a communication. And that's really what I'm hoping that we start helping you all to realize, as you are all investors, as you are all owners of businesses and business ventures. Just know that there are lots of tools out there. And if your current solution for these is not giving you what you want at the price you want and with the comfort level that you want, make sure that you ask around. There are lots of resources. Okay, so here's kind of my approach. And again, I'm going to take a little bit, because I love hiking, I'm going to take a little bit of analogy from the death zone as it refers to a certain elevation level. When people go hiking big mountains, and we probably hear it most about it, like with Mount Everest and some of those big famous ones, there's a certain level that if you get that high, you start to die physiologically. You can't breathe it anymore by yourself. And sometimes I feel like that's where a lot of us give up and just don't push towards the end, because that breathing, that oxygen is kind of like the learning process that's involved. A lot of us just assume our CPA or our enrolled agent or our attorney, whoever does it, is going to have our best interest in heart, and they're going to give us all the strategies, and they're going to proactively come to us and tell us what to do. And that's just not the case. In fact, I just listed 3 different professionals. Most of us refer to the people that do our taxes as the CPAs. Well, that's only one of 3 types of professionals who can do your taxes and file them with the IRS. So the CPAs, so that's one bit of learning today. You have a CPA, you have an enrolled agent, which is someone who's licensed with the IRS, and you have an attorney that's also licensed with the IRS. So I can do taxes because I'm that 3rd category. I'm a nerdy attorney that's licensed with the IRS. But you guys have to take that proactive learning approach and figure out how to get to those higher levels, or you'll just never, frankly, get all the way to the top of that mountain. And I'm not saying that's right or wrong. I'm just being straight with you. You just have to be proactive for your own learning. Another piece that you have to do is that you have to figure out the strategies that work for you. And so we'll talk about a few of those strategies in a minute, but I'm just saying this from a high level. Some people will implement a strategy that worked 5 or 10 or 20 years ago, and they continue to use that strategy year after year. And it may be that strategy doesn't work anymore, or it doesn't work as well. And they may not have realized or continued to learn, and therefore they didn't even know that new strategies existed. And that's the benefit of some of these planning sessions that you should have with whoever's helping you, is to make sure that your learning is keeping up with current strategies. The other side, realistically, that's discouraging is sometimes year to year, the strategies change. The tax laws change. Some of the tax law, the thing that's probably most annoying is some tax laws are put in place with an automatic expiration date. That just drives me nuts, because then we all create these plans that take 1 or 2 years to try it out to see how it works, and then 2 or 3 years later those laws might be expiring or changing again. So you can't keep the same strategy year over year without reevaluating to some degree. And then the only piece of caution as it relates to hiking, so it relates to taxes and business, if you try to bite off too much too soon, you're going to end up with some business pain. It might not be as dramatic as death like you would if you hike too quickly, but you kind of have to say, all right, you might have 10 things that are keeping you up at night as a business, but you probably only can take 2 or 3 of those at a time. And then we address those, and then you take 2 or 3 more and you address those. If you try to take everything all at once, or if you try to invest in fix and flips, and then you're also investing in commercial real estate, and then you're also trying to do a syndication deal all at the same time, I can guarantee something's going to go wrong. You might not even realize it went wrong yet until you find out from an investor or from a partner or from one of the hard money lenders or one of the tenants. I don't know where it's going to be, but I can guarantee, in my experience, if you bite off too much too quickly, something comes back and blows up. I don't know, Chris, from your perspective, I know you've done a lot of different things, and so I'd ask your thoughts on at least that last point on taking things kind of one piece at a time versus too much too soon.
I'm probably the opposite, but I would probably want to revert back to what you said earlier, is the more you educate yourself, like it's kind of hard to navigate anything in life if you really don't know. Like, it comes back to that mantra. I mean, you don't know what you don't know. But if you can kind of educate yourself as much as possible, like always like take it to the consideration of, like, I love Josh. Like, Josh is freaking phenomenal because, again, he calls himself a nerd, but like the power of education is it's extremely important, because you at that point, the more you get educated, the more you know how to navigate through different things, and the more, and even So there's a question that came up, and I'm sure I can answer it, but I'll read it off anyway. It kind of ties into this and what I'm saying. Is there a good planner that you would recommend that keeps in mind taxes, CPA? He's creating a trust and an LLC and wants to make sure it's set up right. So one of the things, and I've heard Josh say this before, one of the things is just because you go to an attorney or you go to a doctor, it doesn't mean that doctor can cure everything, and it doesn't mean that attorney can do everything. Like a lot of times they get specialized in one things, but it's very often you find someone as unique as Josh here, which they do all of it. So and it all came through just kind of self-educating. You say you're a nerd. I'm kind of the same way, but I know how to navigate through different aspects of it because I educate myself a lot. So maybe I don't know if you want to touch up on that, but I talk to people. They ask me this question, and I talk to people. You find someone I think it's very rare. I don't know, Josh, you can probably chime in on it, to find someone that knows the legal side, knows the real estate side, knows the tax side of it, and then because there's pros and cons to all of them, like you said earlier. So kind of understanding and being able to navigate what's good for you and your situation is probably not an easy thing to find. So I don't know, maybe you chime in and see, and maybe tell from your perspective. I'm sure you talk to other attorneys. I just talked to another attorney yesterday, but super specific in one simple things on mergers and acquisition, and that's all he does. So maybe you can talk a little bit more about that and maybe answer this question.
Yeah. No, it's a good question, and I think it's great that you're thinking about it, because that's oftentimes one of the things we as business owners really do poorly, which is to take time to think about the business and to work on the business. We're so caught up in the next transaction, the next deal, the next, whatever our kind of cycle is, that we don't spend time to make sure that the foundation is set up the right way and that we're correcting things and revising things. And there's really no shortcut answer either, because even though it's awesome that Chris likes me and thinks highly of me, that doesn't mean that my personality is going to mix with everybody. And even though I have that approach, I will agree with Chris that it's pretty rare that attorneys understand business, because a lot of attorneys don't know how to run a business. So that's a little bit of a different approach I have. I have a very business focus. But I do believe that there are people out there are professionals out there that can advise you on a more kind of planning, holistic approach. But you just have to communicate as a consumer, as a business, to say this is what you need, and be okay with the fact that that person might say, oh, well, we don't really provide that, or we don't do that very well, because they might be able to refer you to somebody. I mean, if you like who you're working with, don't just completely jump ship and try to find like a one-stop shop. That might not be the best approach right away. Just having that communication with whoever you're currently using, if you like him or her, and then see if they can give you more of these things. And if they can't, they shouldn't be surprised if you decide you're going to look elsewhere, because as a business, you want those things, or you need those things at this point. So
yeah. I also still think it's important too, because a CPA is a CPA, an attorney's attorney. Like, understanding, the more you educate yourself, the more questions you know to ask. Again, it goes back to, you don't know what you don't know. So if you don't know what questions to ask, you might blindly follow someone who really might not know. Again, have been a CPA versus liability on the attorney side. Sometimes they'll direct you where it might not be the right route to go, but you're trusting the person because he's licensed and a professional. So I think a lot of it has to do with kind of understanding what you're trying to do as well, and somewhat educating yourself on the nuances of it. But again, I think it's pretty rare that you find somebody like you that kind of knows all of it. I mean, I was talking to an attorney yesterday, talking to him about different things, and he had no idea what I was talking about. And I'm gonna be honest, I don't really remember right now as well, but I know it was real estate related. So understanding, and I think ultimately educating yourself is probably the first step for everything.
Yeah, yeah. No, but that was a good question to ask. Were there any other questions that have come
Nope.
through that?
Yeah, you guys keep asking the questions, but I'll pop them in as they come in.
Okay, cool. All right, so let's look at, and this is kind of a good segue for you to kind of think about what, for you as a business owner and an investor, what is the system that you personally use or have around tax planning and tax preparation? So how are your taxes prepared? How are they reviewed? What kind of strategies do you use? How do you execute on those strategies? Hopefully those are not foreign ideas, but unfortunately, this time of the year especially, I talk to a lot of businesses and investors, and all they really do is the tax prepare side. They might review the tax returns that are sent to to them. A lot of times whoever's filing it, the attorney, the CPA or whatever, they'll send you a copy of your draft returns. This is a good opportunity to double check to make sure you understand what we're doing and why. I had a client that I did their tax return and I sent it over to them for review. A lot of my clients, I don't think that they review them because they email or they text or they sign the authorization to e-file it like minutes later. And I'm like, yeah, there's no way you looked at that. This particular client reached out with a good question. Hey, why is there an extra $18,000 over here? I don't understand. And it was a good question because as soon as I explained where it came from, he's like, oh yeah, I forgot when I sell certain assets, there's some kind of what's called a recapture on some of the depreciation I had taken on it before. And he had forgotten that. And so that was an educational opportunity for him. But if he hadn't asked the question, if he hadn't had a process for reviewing, he wouldn't have known. And then, but you have to, these are just things you have to have in your own system. And when I use systems, I mean, for you as a business owner, what kinds of things regularly occur? Part of the other things that flow into this would be the way in which you put together your books and your accounting. A lot of you might do that yourselves, or you might have property managers that do it, or you might have investment managers that do it. I don't know who does it, but that all flows into this tax prep system as well. That could be part of the prepare process. And I'm more than happy to chat about, logistically, step by step, how to do these things. Hopefully you all have some way of doing a couple of these. And if you don't, a lot of the ways that I've heard for people to kind of learn and explore some of these ideas, like what Chris was saying, kind of the education, there's tons of podcasts out there. You could listen to something while you're driving to work. There's tons of books out there. I would stay away from the short, cheesy videos on Facebook or Instagram, because those often give the cool one bit of information, but they forget to explain the 10 things as to why it doesn't apply in 99% of the situations. But those videos get thrown around, but they're usually not very complete, and that's a problem. So okay, so here's a couple of tax tips for you as you guys are all doing this. So a lot of you have probably heard about 1031s. 1031s is when you sell an investment property and instead of paying the taxes, you want to defer it. And so you can go through a process to buy another similar property. And instead of paying on the capital gains tax, you'll put that into a new property and defer the taxes through a section called 1031. One of the things that a lot of people don't realize that you could also utilize sometimes is what's called a 1033. A 1033 is a similar thing to a 1031, except instead of selling a piece of real estate, you're selling a business entity. Now, there are all sorts of complicated rules. Unfortunately, lawyers cannot sell law firms under a 1033 exchange. Really sucks. I wish that we could. A lot of service businesses like CPAs can't do that either. But there could be some ways for you in your business, whether they're your real estate businesses or some of your other business ventures, you might be able to use a 1033. And those are ways that, again, you can structure a lot of charitable giving. You can structure different annuities so that you don't have to pay a big old tax bill today, and you can stretch that out over time. So that's one thing to be aware of as you are buying and selling and owning and running various businesses, as well as with real estate. The second category that a lot of people have heard about but maybe haven't fully explored is the ability to be designated as a real estate professional. And I'm not saying like I'm a realtor or I'm a real estate broker, but there's some special IRS rules that allow you, depending on the kinds of activities that you do with real estate and the volume. But if you can be qualified as a real estate professional, oftentimes you can get better, you can carry your losses and your depreciation better through that category than you can through regular businesses or regular LLCs. Now, again, there are specific rules that we have to follow, and I'll just tell you right now, the real estate professional designation is highly audited. At least it was before the IRS lost a lot of employees. So,
let's talk a little bit about that, because I mean, a lot of the listeners out here are either are real estate professionals or aspiring to be real estate professionals. So I don't know if you know the exact nuances between it. I think it's like 750 hours, and one can be, I don't know the exact amount, but if you do, can you possibly talk about that a little bit?
Yeah, sure. Okay, so essentially, and again, one thing to remember is that some of these things can change because these are rules. But so in the case of taxpayers, if you can qualify, then you might be able to prevent the passive activity loss limitation rules and then you could exempt, so there's rules about how much, all right, let me take a step back. So when you're talking about taxes and you're talking about income, the IRS generally defines income through active income and passive income, two general categories. And they have different rules for how much you can deduct or claim based on the kind of income it is, whether it's active or passive. And so if you can get this designation, you can potentially exempt yourself from some of those passive activity loss limitations, so you can claim more of the losses. You could also potentially be exempt from certain investment income taxes that can come up in the real estate side of things. But as to how to qualify, there's generally two or three requirements. Number one, you have to provide more than 50% services in some kind of a real estate trade or real estate, business. So that's called like the 1/2 test or the 50% test. Then the 750 hours that you talked about, you have to do more than 750 hours of work or service in that business. So there's two things, right? More than 50% of the services that you do is in that business, and then at least 750 hours as well. You might think that that's redundant, but a lot of you people in real estate have other businesses, and so that's why they're saying, look, you know, at least half of your time needs to be there, and we're going to also define half of your time to be at least 750 hours. And then the third one, which is a little bit of a gray area of what the heck it means, but you also have to materially participate in the rental activities. So those are the three categories, or the three tests that you have to pass in order to be able to handle that. And there's all sorts of fun rules and best practices for how to document those things. The reason why you go through that hassle is because a lot of times, especially in real estate, you might have more depreciation, or you might have more losses and things on your business than you can actually claim because of the way the active versus passive rules work. So that's one of those things that you have to sit down and analyze with whoever's doing your taxes. And you need to make sure, hey, do I qualify for this? Frankly, just like Chris said, not everybody who does taxes knows how to deal with real estate taxes. I mean, they know how to deal with depreciation and they know how to deal with rental income, that's not really the question. It's the second part, the nuance, kind of the technical side of real estate professional designations. If they don't deal with very much real estate, then they're not going to be familiar with that very well.
Yep.
And there's nothing wrong with asking them, shooting straight with them. A lot of them can file your taxes. So if you ask them the wrong question, they're going to answer the wrong question. Like, you have to say, do you know how to help me qualify as a real estate professional? If they don't know what that question means, then that's probably not your person. So yeah, I don't know. Chris, did you have something there?
No, that was a good way to put it. Yeah, you can even start getting super technical with your Schedule E and see what they answer, and yeah, and if they don't answer the right question, you just run, go find another one that has that has the answer. So yeah, no, I love it.
Yeah.
It's a big thing too on the real estate side of it, like being able to take depreciation, carried losses. Honestly, it's been a gigantic game changer for me. I worked a typical W-2, typical American job, was a corporate executive for a large firm, and I paid over 6 figures in taxes every single year. Didn't know better. I had properties, but what didn't have the status. A lot of it could have been mitigated had I pushed myself to learn more at the time. I wasn't as nerdy as Josh was, so now we're learning. Well, we have another question came in. I think there is a great loophole for taking depreciated losses through short. Oh, okay. I don't know how much you know on the short-term rental side, and because it's not considered passive, it's active. I don't know if you want to talk a little bit about that, if you know about it.
Yeah, I haven't done tons. There's a lot that people are talking about with the short-term rentals, just because that's so new lately. The hardest thing with it is what the rules say and what the audits are going to do. We really won't know how the IRS interprets those rules for probably 3 to 5 years until we start seeing audits and appeals and court decisions from the U.S. tax court.
Yeah. Yeah.
That's the only downside when you do those things. There's nothing wrong with it. That's what the black and white rule might say. But until we actually have a good 3 to 5 years of history, we won't know how the IRS is interpreting their own rules.
Yeah, that's true. Very true. So, yeah.
Okay.
Thanks for the comment, Dan.
Yeah. Another thing that a lot of people don't realize, especially this time of year, is that when you file extensions, it costs you money. Now, why do I say that, and what does that mean? So, the normal, if there's multiple tax deadlines. Hopefully, that's not a news to anybody. But when you file an extension, it gives you a 180-day extension from the normal deadline. And so if you had an S corporation filing deadline, your deadline is, in 10 days or roughly. It's March 15th. Your personal filing returns are April 15th. If you have a nonprofit, your filing is May 15th. So those are the normal deadlines. And if you want to file an extension, you're allowed to. But that gives you 6 months. So that moves your March 15th to September 15th. That moves your April 15th to October 15th. That moves your May 15th to November 15th, roughly. But what happens though in the interim is you're supposed to pay, some estimated payment. And then depending on how your tax return ultimately plays out, and depending on when you actually file it, there's going to be some percentage of interest, penalty essentially, that you're going to also pay on top of it. It used to be pretty small, but it's been creeping up over the last number of years. And essentially, the IRS considers it that they're loaning you money for that period of 6 months. And so just know that I hate doing extensions. Like, I only do it if like clients need it, or for whatever reason things come up last minute and we need to do it. And even if I do, I try not to extend the personal one, because it's the personal one where you get the obligation on payment and the interest payments. So I'm just throwing that out there. If you do extensions, a lot of people do it because it's like, oh, it's convenient, I'll just do this 6 months later. just know that in all the calculation of those forms that you may or may not see, you're paying a little bit of percentage on whatever your taxes are that are owed. And they don't do it the other way. So if they owe you money back, if you're getting a refund and you just take a long time to claim it, they don't give you extra money. But if you owe money and you don't pay it, and because you did an extension or whatever, you're going to pay a little bit of interest on that. So sorry if that's a surprise, but that's something I don't know. I don't think a lot of people realize. The other one is more of like a high level thought process. Is just kind of like in healthcare. In healthcare, a lot of times the difficulty has been with what's called coordinating care. And so this kind of goes back to that same question about how to figure out who can help a real estate professional and going through those designations is just making sure that you have optimized or made efficient your process of retrieving all of your K1s from other investments, from generating your own tax returns for a business and assembling all of this together, making sure your books are up to date. If you have a business, I would hope that your books, it's now the beginning of March, I would hope your books are closed for last year. But I also know a lot of people that's not the case yet. So, being able to have efficient care for you from a tax perspective is a fundamental piece. And so you just need to make sure if you do the books, great. If you have an outside person, if you have another tax person, whatever you're doing, just make sure that those people are talking to each other and somehow coordinated so that they can make sure that they meet your expectations. So one question I had before I click on this link, Chris, do you post these slides anywhere, or do you share this with your group? Or
Yep, it gets posted on our website.
Okay, cool. So if anybody wants, obviously you're going to get these slides. There are a couple of slides, and this is one of them, that there is a hyperlink. In this case, I have like a free ebook on some general tax tips that help businesses. Now, this is not complicated, sophisticated tax stuff. It's just basic stuff that you may already have heard about, but it goes through about 10 to 20 different things that you might want to just review as you're looking at your own taxes to make sure whoever's helping you is taken care of. So when you see the slides, click on the hyperlink, and it's a free ebook download. So you're welcome.
There's another question. I don't think you can answer it, but I'll put it up anyway. It's
Okay.
like when you have K1s from other businesses, and I'm assuming these are other investments. And maybe Dan can jump in and maybe refine his question a little bit more. How do you file timely? My K1s don't come in until September.
Yeah, unfortunately, you can't.
Yeah. Well, I mean, you can, but you'll have an incorrect filing, and you'll need to amend it anyway.
Yeah, that's the downside. When you are waiting on lots of them, the advice of not doing extensions might not apply very well because you don't have control over all of those things yet. Now, if you know what your estimated payment is, like if you know an approximation of how much you're going to get from various K1s, even if you don't have it, the little hot K1 in your hand, you can still put it into your draft tax returns. Your person should be able to calculate your estimated tax obligation, and you could proactively pay it by that April 15th deadline. And then that'll mitigate it.
Yeah, worst case scenario too. I mean, you can overpay or slightly underpay. So obviously, slightly underpay, you're going to have some interest liability there, but you can still somewhat mitigate. And if you overpay, you'll get the money back when you file anyway.
Yeah. So, again, I can't remember what the current rate is, but it's like somewhere between like 2 and 6%, somewhere in that range. So if that doesn't make a difference in your world, fine. But if my obligation was that I had to pay $100,000, well, $5,000 extra just because I delayed it seems like a lot of money. Mm-hmm. But again, that's going to be one of those strategies you have to practice to figure out what makes the most sense. Okay, so asset protection. So what the heck is it, and what isn't it? So asset protection is kind of like this really sexy term that a lot of people throw around, and I don't know that we think through all of the realities. And I have a picture of, if you don't see it, if you're just doing the audio, I have a picture of a seesaw on the screen. And in my childhood, I loved playing on the seesaw. But what was fun about it is, one person goes up, the other one goes down, and of course you like to cherry bomb somebody, and so you make sure that they're all the way up in the air, and then you jump off so that they slam down. So that was super fun times. I don't know if my kids could play those games today anymore, but I enjoyed it as a kid. Why I use this as an example, though, is with asset protection, there is a give and a take. There's an up and a down. There is an action and a reaction to whatever strategy we use. And every time I talk to clients about this, it makes sense. It's just not something that a lot of people have articulated before. So typically, asset protection is intended to provide you with protection from liability, from taxes, maybe privacy issues. But in exchange for that protection, you typically give up flexibility and you pay more in taxes for it. So, that's just a very high level summary. Now, there are asset protections people use for Medicaid. There's asset protections people use to hold real estate. There's asset protection so that you can hold life insurance or have commercial real estate investment holdings in something really fancy called a Delaware statutory trust. There's asset protection for international trusts, so you can try to not avoid taxes, but be more strategic with your taxes. So there's a ton of different. Frankly, if you love your pet, you could put together an asset protection trust to make sure that your pet is cared for when you pass away, assuming your pet outlives you. So there's tons of these kinds of things out there. There's definitely not a one size fits all approach. And so what we're looking at in the traditional sense, like I said, is shielding liability, is planning for taxes, is looking at privacy, looking at how our business goes from one generation to the next potentially. Now, just to clarify, so I don't sound like I'm talking out both sides of my mouth. When I say asset protection is designed for taxes, I also said, but you pay more in taxes if you have it. And here's how both of those things are true statements. So when somebody passes away, the government will assess what's called an estate tax. Now, the government could be both the state and the federal government. I'm, talking to most of you here in Utah, so I'm going to assume most of you are Utah residents, but this is going to change state to state. Utah does not currently, and those are both two important words, it does not currently have a tax on anybody's estate at the state level. Other states do, like California does. Now, separate from that, the federal government, the US government, has a tax on your estate. Now, the reason why a trust, in the case of an asset protection trust, might be beneficial is if your estate is bigger than about $14 million, and I hope you all have that problem one day, but if your estate is over that amount, then when you pass away, the federal government will assess a 40% tax on anything over that threshold. Now, that number has gone up and has gone down over the last 20 years, which is why it's important to make sure that you have someone proactively looking at things with you. So that's the reason why you can put assets into trusts in order to protect against taxes in the future. Downside, if you put an asset in your trust, which is an income producing asset like a piece of real estate, that trust is considered its own separate entity. It has to file its own tax returns. It has its own EIN, and it will reach the highest level of a tax bracket much earlier than you as an individual would. So if you were married filing jointly, the highest federal tax bracket is just under 500 grand. I think it's like 470, 480. I don't remember. They're always changing, but that's where that's at. If you are an irrevocable trust, which is the typical asset protection type of trust, then you reach that 40% threshold with income of only about 15 grand. So yeah, you're going to get liability protection, but you're giving it up in taxes. So it's really important to think carefully about what kinds of assets we put into an asset protection trust. Is it going to be an income producing thing or not? If it is, we need to know the ups and the downs for it. Again, there's no one size fits all approach. These are things to consider. Liability can be done in a lot of different ways, sometimes with LLCs, sometimes with trusts. Privacy is another reason people explore asset protection. But again, you can accomplish some of that with LLCs and other corporate structures to keep your investments and your holdings private. And then the other side is just the succession of your business and of your estate, whatever you've accumulated over the years. Trusts and asset protection can be a tool that's used in order to accomplish the succession goals that you and your family might have. But again, these are high level things because everybody's situation is very unique.
Let me ask a quick question on that. I don't know if you're going to get to it, but because I hear it a lot, is the tax implications from, and maybe let's just say real estate, maybe rental properties, the tax implications of having it in an LLC versus having it in your own name. So maybe talk through that. 'Cause I do hear it a lot, and I think there's a big misconception of it out there. So if you can maybe just talk, what are the benefits, what are the pros, what are the cons, and yeah, maybe kind of just take it from a high level.
Yeah, sure. Well, first of all, if you want to be considered that real estate professional, you're probably going to have to put it into some kind of LLC or some kind of an entity in order to make the IRS believe you're a real estate professional. So that's one of the things you're going to need to do. But from just simply how is the asset going to be taxed, personal versus business, if it's a personal one, it's going to show up on one of your schedules, usually your Schedule E for rental income. Then that shows up on your personal return. You can still depreciate it. You can still have expenses and those kinds of things. There's nothing necessarily wrong with that strategy. When you hold it through an LLC, it depends on what kind of LLC. If it's a single member, like you're the only owner, it's going to be considered a disregarded entity and it's going to still show up on your personal tax return. If it's an LLC that has multiple owners, so it's going to be taxed as a partnership or an S corporation of some kind, then that would be its own separate tax return, and that asset would be considered on the balance sheet and the assets of that company, which can be taxed differently. And you would have a bunch of expenses that are flown or carried from there over onto your personal ones eventually. I mean, if you're saying dollar for dollar, I get $100,000 out of this or $100,000 out of that, it's going to be fairly similar, except for how does that money flow to you? And what I mean by that is, if you are set up as a real estate professional, or if you are receiving a wage from your real estate holding property company, then you might be, well, I would hope you're structured in such a way that the profits that come out of that are going to be exempt from self-employment tax or from rental income. So having an entity holding it is going to give you a lot more flexibility for those strategies than just simply holding it in your personal name. Holding it in your personal name is kind of like a W-2. It's probably one of the worst ways to be taxed because you don't have a lot of tools that you can use to quote unquote play the game. Now, that doesn't mean that. So my younger brother, he always, like, I give him all these things, all these ideas and strategies, and he rolls his eyes at me and he's like, yeah, man, but is the lemon worth the squeeze? So, I mean, That's a fair question. And so after I'm done smacking him for his, because he's my younger brother, um, and that's really a personal question. Is the lemon worth the squeeze? Some people like to use series LLCs because they don't want to manage 8 different companies. Some people don't want to use a series LLC because it can complicate insurance and tax structures, especially when we're trying to insure different things or get new loans or sell some assets, but not all of them. There's no right or wrong. They're 2 different strategies. And that goes back to that first question about making sure you communicate with whoever's helping you execute these strategies to make sure that him or her understand what's going on and what you're looking for. If what you're looking for is, I want to pay the least amount of tax possible, and I'm willing to spend money to restructure things if that's what's needed, and I'll go through the hassle to do it, versus I really want it as convenient as possible, and I'd be happy paying a little bit more in taxes because I just don't want to deal with the hassle of managing 6 different LLCs. There's no right or wrong, but anyway, so that's how that's handled from a liability standpoint, not a tax one. Holding property in your personal name is not a typically good idea, just because people are going to file a lawsuit at some point. And if that lawsuit, and if the insurance you have doesn't properly cover that lawsuit issue or that loss of or claim or whatever, then they're coming after you personally because that's how you held that property. So there's taxes and then there's liability. Were there any other questions as a follow-up to that, or?
Nope, that was good.
Cool. I won't get big into these entities because I don't want to take you guys forever. I was hoping that we'd kind of do this in about an hour-ish. So I got about 5-10 minutes left. So I will just throw up here that there's lots of different entity structures. One, I had a discussion earlier today with some business owners, and I wanted to kind of just flag an answer that I gave them because they said that they don't usually hear it put this way very often. But LLCs and corporations and S corporations give you the same identical liability protection. The distinction between those types are usually from a tax strategy. So don't fall into this tax, I do this because this, or I can hold this because of that. The distinction is a tax distinction. As long as you honor and you follow the rules that apply to the various entities you've structured, which usually means that you don't commingle your personal, finances with your business stuff, then those will all give you the same level of liability protection.
You know what? Maybe talk about that commingling a little bit too. I think that's important, and I think most people don't understand it, especially if they're. I mean, you like myself. I don't know how many businesses I got. There 20 or 30 different entity structures out there. So maybe talk a little bit about commingling and what the liability is there, just so we can get a little bit better understanding.
Yeah, commingling as a definition is just simply when you mix business and personal expenses in your business accounts. So I know some people say, no, as long as I claim it as an owner draw, I can use my business credit card for my personal family grocery shopping. Yeah, from a tax perspective, that might be true. But when you start to show a pattern of confusing or of treating business assets like they're personal assets, or that there is no true distinguishing line between the two of them, then at some point someone might come along and they might successfully be able to convince a judge that you have not treated this company, this LLC, this corporation differently. Therefore, the liabilities of that company should not be treated differently, and they should all come home at your footstep.
One more question to follow up, because my understanding that it's true. You cannot commingle between entity. Well, you can. You obviously can, but wouldn't that impact the liability structure and again piercing the corporate veil in between entities?
Yeah. Yep. The same is true between companies. And so if you have multiple companies for multiple different properties that you're holding or renting, then you need to, I know, and this is again, goes back to that convenience versus protection dynamic. So if you have 3 companies, you should probably have 3 different credit cards and 3 different bank accounts and 3 different books. And that's kind of how it's handled. Now, some people get around that by setting up like a management company, and then you make sure that each of those LLCs gets their rent, and then they pay all of the money over to the management company. And then the management company does a bunch of expenses at one credit card and one bank account. And then they distribute to you, the owner, whatever profits are there. That structure is fine because you've paid everything into this management company through, I would hope you'd have some kind of an agreement in writing to make it black and white. You just kind of have to treat it as if you have investors and partners, and they wouldn't want you using company credit cards to go buy personal groceries unless everybody was doing the same thing. And then that's not a normal thing partners do. So yeah, you have to treat them safe. You have to treat them separately if you want to keep the protection that you're trying to achieve. So, and on this slide, there's another hyperlink for more details. I have a link on my website for a free breakdown. It has like, 3 or 4 different entity types, and it goes through about 10 or 15 questions, compare and contrast different types of structures for tax, for convenience, for all those things. So again, that's just a resource for you guys to look at for your own education. I'm going to, let's see here. I think I'm going to skip over the death and the tax, or the death part of this, just because we've talked a lot about taxes. But I will just say that as owners of real estate and as owners of businesses, nothing happens automatically. It might be possible that you have a piece of property that you own jointly with somebody. But generally speaking, if you don't have a will, if you don't have a trust, your family's going to have to go to court through the probate process in order to get stuff divvied out, sold, authorized, updated. If somebody's passed away, you should correct the deed, and there's ways you can do that. If you're going to be selling assets or entities as part of somebody's estate plan, there's different strategies to make sure it's clear how the taxes are going to be handled. This is probably more of a customized thing, so feel free to reach out if you have questions about any of those things. And to that point, if what I always tell clients is probably every 3 to 4 years, you should revisit whatever documents or structures you have, because the tax laws change and your situation and your family priorities probably change. And so if you have something, great, make sure it's still current and effective. If you don't have anything, it should be a top priority for this year to try to make sure you at least have a basic plan put in place. Just kind of, I just throw this in here because as you are trying to grow your real estate business, hopefully there have been some things that we've talked about that make you want to, reevaluate and grow. But that second point that you have to do along the way is you have to figure out how to better protect it. Protect it from lawyers, man. Lawyers suck, right? They're always trying to find ways to pierce things, to sue people, to get a bunch of money, somebody slip and fall on your property. Like, you just need to make sure you're up to snuff on being protected and safe. And you want to keep more of your money. And that comes from the tax strategies. So I encourage you, if you haven't done it already this season, talk to whoever does your taxes and make sure that you talk about ways. It might not help for last year, it's already done, but how to keep more of your money. And that leads into ultimately how to eventually exit. Are you going to sell it? Are you going to sell all of your real estate as a portfolio? Are you going to sell one piece at a time? Are you just going to manage it until you eventually just don't wake up? I don't know. Like, everybody's different, but you got to think through those strategies and revisit them periodically to make sure that what's there is still what you intend for it to be, as you go through this process. So, wild card. I don't know if there were any other random questions that came in that we needed to try to hit before we wrapped up.
Nope. I think we're good on the questions.
I'm going to skip some of these ones here, just for the sake of time. I will say this, this slide has a QR code on it, and so you'll get this online. If you're on your computer, you could scan it. I kind of got a little bit frustrated with the lack of information that went out with all the BOIs and with people not getting, timely notices of workers' compensation claims against them, or labor claims, or easement notices, or all sorts of real estate crap that goes on. Like today, I had somebody who had a fair housing complaint filed against them as a landlord, and they didn't get notice until it was too late. And so anyway, I don't know who does your registered agent stuff, but I'm offering it to you guys for free. If you're already one of my clients, great. You don't get anything extra. I'm sorry, but but if you don't know who your registered agent is and you need help making sure, scan this and it'll ask you a few questions, and you can definitely have us take care of that so you don't miss any of that important information. Wrap up homework, kind of 3 things. Look at whatever your tax prep system is, and that includes talking with your person to make sure they accomplish your goals. Number 2, you got to look at and revise potentially your estate and the plans. And then number 3, look at your asset protection. There's lots of different ways all of these things are handled. There's definitely not one size fits all. So if you go to, this should be a warning to anybody. If you go to an attorney or to an accountant or CPA or whatever, and they have the one way to do everything for everybody, I would run the other direction, because that's not very fair to you. It might make sense as a business to only do one way for everybody, but that's not probably what makes sense, especially in an industry like yours for real estate investment, real estate development, real estate rentals. That's, it's just not a one size fits all approach. Lastly, you don't care about that stuff. I did say I'd also give you an opportunity to do a follow-up call. So this QR code takes you directly to my calendar, and you can find a slot. Just click on something that works for your calendar, and then it's just a quick 15 minutes, just a phone call, and we'll just chat about something we've talked about now, or something else, or the weather, or my favorite hiking mountains, whatever works. We'll talk for a few minutes and make sure you're getting some tools and some education. In fact, one person that called me up recently, they didn't need to hire me as an attorney. They didn't need to hire me as an accountant or CPA or anything like that. They just wanted to understand a couple of books that they could read to help them be a better business owner. That's a cool compliment. They called me for that. So just know that you're not getting charged for it. So if you have something, I'm happy to chat.
Now I got to put you on the spot, man. What is that? What is the book that everyone should be reading?
So one book that you should definitely read is called Buy Back Your Time. I think, hold on.
Read that yet?
I think
thought you were going to bring up like Traction or something. By who?
By Dan Martell.
I need to go get that one. I have not read that yet.
Buy Back Your Time. It's also on Audible. So I have listened to it twice, and I got to read it now once, because I'm a nerd. You're not going to retain tons of information by just listening, but I like to listen, and then I like to get it. If I like it enough to listen to it, I'll get it, and then I'll actually study it. So, but yeah, that's a big book. And then the second one that I recommended to this particular person is a book called it's called Who, Not How.
Dan Sullivan.
Yep, Dan Sullivan.
Yep. That one I read.
Yeah. And that one, the basic idea there is just we always focus on how we do stuff instead of focusing on who can help us do stuff. And that's true in any part of business. So anyway, that's all I got for you guys. I don't know if there's any other follow-up questions you have.
Let me see. Type in the 2 books in the chat so you guys can see it. You guys can copy it. No, I think we're good, man. I really appreciate it. Thanks everybody for joining. And honestly, Josh, thank you for coming down, spending some time, imparting your wisdom on the group, and hopefully you guys learn something. And the one thing is just really go out there and continue to educate yourself. And honestly, just take action. Look at Josh gave you some good pointers on questions to ask. He gave you free 15-minute sessions to talk about the weather and awesome books and and audiobooks. So take advantage of it. Like I said, just take action. And our goal is to help you on your journey. And Josh is there along there, willing to be along with you. And we're just hoping that, again, you guys got these nuggets from today's session, today's webinar, and you guys are gonna, it just makes you that much better for whatever your life looks like and whatever journey is. So again, Josh, thank you very much. I really appreciate it. And thanks everybody for coming.
Thanks, guys.